Hi all, let me introduce myself. My name is Natалья Смирнова, and I'm an investor, a blogger, and an entrepreneur, and an IFA based in Moscow, Russia. I've been in financial industry for almost 20 years so far, and today I will be moderating a webinar devoted to behavioral finance. And this webinar has been organized by the CitiBank. We'll be covering a lot of interesting topics. Well, first of all, we'll start from the most common investor mistakes worldwide. Then we would speak about the pandemic and how it changed investors' attitude towards risk and reward and all the stuff. And then we would switch to the difference between investors in developing and developed countries, including Russia. Are there any differences or not? Etc., etc. And as you can see, I'm saying we, but not I, which means that I'm not alone today. And I will be covering all of these topics with Anders Andersson, the professor of the Stockholm School of Economics. And so let me introduce Anders Andersson to you now. Hello, Anders, how are you? Hi from Moscow.
Hello. Thanks for inviting me. So I want to share my thoughts here about these topics. I have produced a few slides, so just bear me 1 second.
Yeah, sure.
I'll try to share them with you. So what I want to talk about is some classic investment mistakes that we have seen in research all over the world, I would say. And I want to relate these mistakes to what psychologists would call overconfidence, which is the, hang on, I became green here. See if I can fix this. No. But you know, sometimes you tend to be overconfident about technology as well, like I am. And you think that you can actually manage to do a webinar without having a green screen, but never mind, I'll put myself out of the picture. But essentially, this is the tendency for us to overestimate our true ability when it comes to our own performance, okay? So this is a very human trait, and it's been known for a very long time. So I listed a few examples that are not from finance here. So for instance, 65% of Americans consider themselves above average in intelligence. 93% think they are above average car drivers. And my favorite example is, of course, the Frenchmen. So 84% of Frenchmen believe they are above average lovers. All right, so I can list examples, plenty more examples, but you get the idea. And I think that overconfidence this way, it looks funny and, you know, it's strange, but in many ways, I also think it has served human beings over time. So for instance, we might have not had people populating space if we didn't have overconfidence. We might not even have populated Europe, you know, 20,000 years ago if people in Africa weren't a little bit overconfident about the possibilities to live in Siberia and other places. Never mind. Okay, so, but in finance, this could be really dangerous. So as it turns out, this, I believe, can lead us into 3 very common investment traps. So the first one I want to talk about is that you think you know when to invest, and that's something that we in finance call market timing. So you go in and out of the market or individual stocks because you think you know when to do so. The second one is thinking you know how to invest. So many people trade too much too often, and therefore they incur unnecessary costs to their portfolios. So by cost, I don't only mean the fees, the transaction fees that you pay for these events, but also the bid-ask spread, which you see in the stock market, that the sale price is usually a little bit higher than the purchase price and so forth. So you can lose out if you do this many times. And then finally, what to invest in. So many people, I think, know too well which stocks to invest in, which results then in too concentrated portfolios, or they only hold only a few stocks or a few bonds, or they only focus on one country or one industry and so forth. And this results in unnecessary risks that could be avoided by holding much broader portfolio of assets. So by these three examples of mistakes that is very common, I want to actually convince you that they are indeed there by showing you some research on that exemplifies this. So the first then mistake is when to invest. So this picture shows the average price path of stocks that are bought and sold. And this is a sample of 60,000 individual investors in the US. And you see two graphs. And each of these graphs, they represent roughly 2 years. You see it's from minus 504 days to minus 1 day, and then it's plus 1 day to 504 days ahead. So you can view the left graph as before. So before the transaction people made, you can see that the price has been going up. So this essentially means that people tend to buy and sell stocks when the stock market is up. We will get back to that, but that's what people usually do. There's much more activity when market goes up than when it goes down. So, but that's not so interesting in this picture. Now, if you look very carefully, it's not that apparent here. I'm sorry for the graphics here, but what it shows is that the purchases, which is this solid line here, this line is below the sales here, which essentially means that stocks that people buy go down in price compared to the stocks that people sell. So in other words, they would be much better off doing the opposite. They should sell the stocks they were buying, and they should buy the stocks they were selling. Okay, so these are all on averages, but it tells you that people in general are really bad at market timing. That's one mistake. Now, the second one is to think about how to invest. So this graph shows average performance across investors in the same sample of 60,000 investors in the US. Now, to the very left of this graph, you see 4 bars here that rank from 1 to 5. This is essentially sorting individuals based on turnover, so how often they buy and sell stocks. So in the first, call it quintile, you have the 20% of the sample that trade the least, and the top quintile, number 5, you have the people that trade the most. Now, what is interesting here is to look at the performance. So you see in the white bars, they show the performance or returns of these portfolios without taking all of these transaction costs into account. And you see that they are fairly stable. So it's not that people in general buy the wrong stocks depending on how much they trade. If they wouldn't have traded, they would incur, they would have received the same kind of return. But what is interesting to see is the returns after the transaction costs. So actually, let's call it the net return, the return that you actually get to your portfolio after having paying all the costs that you incur by trading. And these are much, much lower, as you can see here, for those who trade the most. So in other words, on average, people who trade the most are also the people that have the lowest returns on average. And this is not an artifact of the 60,000 investors in the US. This is something that I have confirmed myself in a sample in Sweden. People have looked at other markets, Russia, Taiwan, you name it. This is a general pattern. But note, this is not saying that there are some people that trade a lot that also earn a lot. It's just that there are very few of them. So on average, the people who trade the most are actually the people that lose out. That's a clear message from the research that we do. Now, finally, I want to talk about what to invest in. So these graphs are a little bit more complicated. So let me explain. There are 4 graphs, but essentially all of them show the same thing. So you would have on the x-axis, the horizontal axis, you would have a measure of risk. In finance, we talk about standard deviation. So think about it, the risk level is on the x-axis. And then on the vertical axis, the y-axis, you have the average return of the portfolio. So you can think about it that each point in this graph represents a portfolio which has an average return for a given level of risk. And clearly what you want to do here, you want to have for each risk level, you want to be as high as possible up in this graph. And all of these gray dots that look like a swarm of flies, there are individual portfolios. Again, these are the 60,000 people that we talked about before. So this is a big sample, a lot of investors. And they're all over the place. That's one conjecture that we can do. The second one, which I think is interesting. So in finance, this is a tool to figure out how to invest efficiently. And sometimes we talk about the market portfolio. So think about the market portfolio as the world index. So a world index would also be a point in this swarm. And then you can draw a line, say from the risk-free, say you have cash holdings, which you have very, very low return, but you can also invest fully in, say, the index portfolio. And then you can choose any combination of the two. So that would trace out this line. So any combination of the world index and the cash or bond holdings that you have, you can sort of stretch out and you can figure out what kind of risk that you want to take. So all these portfolios would then line up on this line. Now, if we understand the graph now, what we can conjecture is that there are very, very few points above this straight line, which means that there are very, very few people that actually beat the market. In fact, if you count all of these gray dots, you would figure out that it's something like 90% of all these dots are below this line. So in other words, 90% of people, they are losing from just having a very simple investment strategy that would be using a readily available benchmark. So, but that is not what we see in the data. So what we see in all over the world is that a lot of people have very few stocks. So the median, sort of at the 50% of the distribution of investors, these people hold something like 3 stocks in their portfolio. In Sweden, it's only 2. And I know all over the world, you have similar conjectures about this. So this is a little bit surprising to financial economists like me, that people tend to hold such concentrated portfolios, even if we have known this for 30 or 40 years now, that you should really diversify in order to minimize the risk for any return that you're seeking in the market. All right, and so finally then, it's easy for you to throw out all the problems that we have. Do you have any solution to them? Well, I think when I talk about this, I think awareness is maybe the most important feature of this. You have to be aware of this sort of natural that you really think that you know better than you actually do. So you should be very skeptical about your own ability to beat the market or take a lot of bets and so forth. The second one is, so this would sort of lead you to maybe have a more passive investment strategy. You might not want to change your portfolio all the time. You want to have a long-term view of what kind of portfolio that you want to, what kind of risks that you can bear in the long run. And the third point I have is about financial advice. So given that there are relatively few people that know finance, I think financial advisors are really important in this market. And there is also nowadays plenty of other investment vehicles available at reasonable prices. So there are mutual funds, there are ETFs and so forth. Sure, they come at a cost, but given all the material that I've showed you so far, I guess that many of these costs are quite small in relation to the returns that people are forsaken in these having these concentrated portfolios. And finally, this sort of puts the finger on something that I'm very interested in my research is about, consumer information and education and so forth. This is much more complicated, but, I think more and more important decisions have been shifted over from the government to consumers all over the world, especially when it comes to pensions and so forth. And, I don't think people are all prepared financially, education-wise, to take on this responsibility. So I think this is a clear challenge going forward. So sorry, I took more time than I expected. I think I'll just stop here and take questions. So thank you very much for listening to me.
Thank you, Anders, for this really in-depth analysis and for sharing your expertise. Yeah, indeed. I would confirm that diversification, passive investments, passive index and long-term investments are really crucial for success, because I have a lot of clients taking bets on, say, Alibaba or Tencent or Amazon or whatever, and now they are just experiencing some kind of stress. They are really under stress because of the things happening in the Chinese market, and they wouldn't have been experiencing such stress if they had made a well-diversified portfolio from ETFs and not taking bets just on China or just even one or two companies. By the way, Anders, have you noticed if the pandemic changed anything? I mean, in which way? I mean, last year, the year 2020, was really the year of private investors. Millions of new investors came to the markets and they got enormous returns. And now they might be taking this for granted. What do you think of this?
Well, yeah, so you're right. I think it's very interesting. So first, I remember it very clearly. So in the spring of 2020, the market dropped by more or less 30% in just a couple of weeks. I think that was one of the fastest drops ever in the world stock index. But then it recovered very quickly. And this is very interesting because I think it coincided with a lot of people starting to work from home, and trading by individual investors surged. You can also see that actually in the profitability of the online broking industry. So I think one difference which is important is that many new investors, which are presumably inexperienced, came into the market. And trading sort of individual stocks have become entertainment for some people. But I suspect that it's not until the market comes down that people also realize that there's risks to these investments.
Oh yeah, you're right. By the way, on a separate note, I would like to say and stress that if either me or Anders mention any specific instrument, any specific stock, or any specific bond or whatever, this is not an individual investment recommendation. It's just an example, and we are not going to recommend anything to you today or whatever. We're just giving examples, so just not to confuse anything. Okay, Anders, and have you noticed that private investors have become maybe more rational, or it is just the way on the contrary?
Yeah, so I think these behavioral biases that we talk about, they are sort of generic. I think people are pretty much the same. I think what has changed is that the marginal sort of investor that are trading in companies might be individuals now and not institutions. And I think maybe a stock that I don't recommend, but GameStop is a good example. So institutions and particular hedge funds, they avoided taking bets in these stocks, even if it's very hard to understand sometimes what the fundamental value of that company is or why they have that particular valuation. So from that perspective, that's not rational to me.
No, it is absolutely not rational, not rational. And speaking about developing and developed countries, do you think investors' mistakes are the same, or are there any specific biases of investors in developing countries?
Yeah, that's a really good question. I think the main difference would be that financial education probably differs across developed and developing countries. And there's also research that shows that once you lack knowledge, you're more prone to resort to these behavioral cues instead when you take decisions. So in that way, one thing can actually lead to the other. But I do think that the basic behavioral traits that we are covering here today, they are sort of universal. We're all part of the same human species. But I do think there's another mechanism which is not completely related to overconfidence, but it's about past experience and what we in the US or in English call saliency. So past experience have been shown to be important to explain how people make choices. So there's a very important but old paper is called Depression Babies from the US. But what they actually showed that different cohorts born at different times throughout the 1900s actually take different amounts of risks later in life. So depending on your experience of the economy when you were young, that will sort of have a role for what kind of risks that you take on later in life. So this seems to be an important mechanism, these past experience. And obviously this could be very different from developed and developing countries. I actually have some research which I find interesting myself when I look at ESG investments. So it turns out that people that are exposed to weather shocks are more inclined to invest into ESG assets. So that's sort of the same mechanism at play here, I think.
That's interesting. And if we, for example, speak about Russia, because I think that most of the participants are from Russia, they would be eager to know, are there any prejudices when it comes to common mistakes made by Russian investors? I would say that I've noticed 4 main prejudices when it comes to Russian investors. And if you don't mind, I would ask you, Anders, just to give some comments for each of the 4 prejudices. First is the prejudice of investors. Well, I wouldn't call them investors, actually. I would say people over 50 or sometimes even 60. Well, they would not trust investments at all. They would stick to allocating their savings into cash, mainly in US dollars or maybe euros, not rubles, no way. Or they would buy real estate just for rental income, and that's it, full point. They would not trust stocks, bonds, because, well, these people, they lost their money during perestroika period, and so they are afraid of everything now. Do you think this might be treated as a kind of an overconfidence, that they are overconfident that they cannot trust anything?
Yeah, but I think the mechanism here that you describe lines up pretty well with what I explained about depression babies here. So these people have been exposed to a very negative event earlier in life, and therefore this will, they will take that into account even in the future, even though it might not be so rational all the time, because investments should all be forward-looking, right, not backward-looking. But another issue here might also be financial education. So I don't know, I'm slightly over 50 myself, but I don't remember. But say that if I was experienced in the days of the Soviet Union, I might not know so much about the stock market to begin with, right? So that might also be like an important channel, that this is something new that people don't know so much about, and maybe it's easier for younger people that get exposed to stock markets to accept it in a way.
Oh yeah, and speaking about young people, they would, on the contrary, treat investments like gambling, and that's another prejudice typical for Russia, or maybe not only Russia. Because what I see is that people under 30 or 35, maybe, they would treat investments like gambling. And they would think, they would reckon that it's okay just to attend one or two webinars to get an overall understanding of how financial markets work and to become experts in investments. They would need no financial advice. They would need nothing. They would be asset managers for themselves. I think this is also kind of an overconfidence, isn't it?
Yeah, absolutely. I mean, first of all, there's plenty of evidence showing that young people, and particular males, are the ones that are too confident about themselves. And that's not only in finance, that is in many, many areas. But what I was going to say here is that if we dig a little bit deeper, so the real danger if you're overconfident is that you're likely actually to be more overconfident in things that you know less about. Okay, so this is what psychologists call metacognition. So that's sort of the knowledge about knowledge, or knowing what you don't know. So it's very tough to know what you don't know, right? So therefore you tend to overestimate that. And this is probably also another feature is this flip side of depression babies, right? That if you're 30 years old, you haven't really gone through any hardship at all. So you think it's so easy to make money that you get overconfident. So you learn to be overconfident as you go along because you're only making more and more money. So this is also very dangerous, obviously, for the long run.
Indeed. And speaking about another type of overconfidence, I would say that I've got another prejudice, very typical for Russian investors, I mean private investors mostly, that they are overconfident that they could themselves pick 1, 2, 3 stocks or bonds without paying any fees to asset managers. So it is more rational from their perspective, from their point of view, just to save certain amount of money, not paying anything to asset managers, to professionals, but to pick just stocks, bonds themselves, even if they pick 1, 2, 3, 5, or 7 equities, instead of investing in 3, 7, 10 well-diversified ETFs. ETFs are not that expensive when it comes to asset management fee, and they tend to have nil success fee. But though most would prefer to pick stocks and bonds themselves and not to pay anything to asset managers, which they call fat cats. What do you think? Is it a kind of an overconfidence as well?
Yeah, I mean, it's a two-sided coin here, I think. First of all, obviously, you don't want to pay fees because that will have a drawdown on a portfolio. But on the other hand, I showed you a lot of evidence, actually, that people are underperforming massively in the strategies that they are doing already. So choosing between two bad things, I think most people actually would benefit from including some of these more diversified assets in their portfolios. I think one of the main problems here is that I show you all these pictures, but I don't think that many people actually do this calculation themselves. They never actually made a performance evaluation of their own portfolio. This is very, very difficult to do. And psychologically, it's something you presumably many times want to avoid because you don't want to hear the bad news. But that is certainly an important hurdle for people, that they don't really know how their portfolio performs to the counterfactual, which would be that I gave the investment mandate to someone else.
Yeah, indeed. It is very disappointing to learn that you are worse than the market. with no fees included, by the way. And the last but not least prejudice that I would mention today is that Russians would stick to meme stocks rather than blue chips, because they would reckon that meme stocks, like, well, again, this is not an investment recommendation, that's just an example. Meme stocks like, again, GameStop, AMC, and all that stuff, they could bring them a lot of money. And blue chips, they are too boring. They're tediously boring, like just, you know, ExxonMobil, Coca-Cola, McDonald's, and all that stuff. Again, this is not an investment recommendation, but just an example of this or that stock. What do you think of this? Because, well, I personally suppose that it's not that good to start your portfolio from meme stocks with no blue chips included. So that's, we've got no diversification at all.
Yeah, I mean, that's obviously very dangerous. So you know, obviously there's some people out there that can make large short-term profits, and they can shoot from the hip and buy some small company stocks that surge in value. But I think the problem is it's sort of a dynamic game, right? If you're thinking about the portfolio. So when you sell one of these stocks and make a profit, what are you going to do? What are you going to buy next time? I think there's a big difference, I tell my students, between speculation and investment. So speculation is okay if you're aware of that you're speculating. I mean, you might have fun buying these stocks and you can chat with your friends about them. There might be other ways of enjoying investing that has nothing to do with risk and return, right? And that's fine with me as long as you're aware of it. But it's not investment. So if you're in for the long run and you want to preserve value and you want to see your savings grow, you should think carefully about how to invest and to do it correctly.
Oh yeah, indeed. I personally have around 10% of my portfolio for trading or even gambling, I would say. And sometimes.
And the rest is boring stocks.
Yep, yeah. Very boring ETFs, index-based ETFs for long-term investments. Yeah, with fees, but they are very, very low compared to asset management. So yeah, I have allocated just 10% of my portfolio for to gambling, and that's it. Sometimes, from time to time, yeah, I buy. Yeah, I must confess, I buy meme stocks, but that's I would say for fun, for trading, and that's just maximum 10% of my portfolio, not more than that, because 90% is for my future, and 90% is just ETFs, index-based, and that's it. Yeah, that's boring, but it works. Well, Anders, we've got a lot of questions. Some are in Russian, some are in English. So I would translate the one that are in Russian into English so that we could answer them. I would start from the first one. The first question is about information bottleneck and how to deal with that when you're gonna concentrate on a specific stock. What do you think of that?
Well, I think it's a really good question, and I think now, given that you have so many stocks listed in the world, I think only in the US it's something like 10,000 different stocks. It's just impossible as a private individual to think that you can follow what happens in the market, and that's why I'm so prone to recommend more passive strategies. So think about, you know, index composition, and even though it's boring, but think about how to get diversification efficiently. I think that, I mean, basically my graphs show that you can be a very stupid and passive investor and still earn more money than 90% of everyone else. So you just do that and you drink coffee, or maybe it's tea in Russia, and take it easy instead of trying to learn all of these things about all the companies. That would be my main recommendation.
I would totally agree with you, because, well, we are living in such a time and such times that it is absolutely not possible to neglect the piles of information that is surrounding us. For example, you cannot concentrate just on again, this is just an example, on ExxonMobil stock, and to learn profit, price to earnings ratio, price to sales ratio, and all that stuff, without taking into account interest rates hike and quantitative easing and all that stuff. No, it is not possible to think only about ExxonMobil and not to think about the economic cycle, the rotation, and again, all that stuff. So either you gonna deep into this information, or you're gonna stick to passive strategies with no allocation to specific stocks and have no stress. So yeah, I absolutely agree with Anders in this case. The second question is again about psychology. The situation is like this. So our participant cannot start investing, though she has certain savings. She was able to set aside certain savings even when she had practically no money. Yeah. But now she cannot start investing because, first of all, she is afraid of investing. And secondly, she doesn't know what to do with the profit. So she's asking us what to do with these two biases, with these two thoughts that prevent her from investments.
Yeah, but I think one should realize that there's a clear risk of not invest as well, right? It's not the best thing to have all the money in your bank. Something can happen to the bank, something can happen to the currency, there can be inflation, there can be all sorts of nasty things going on. So I think diversification is also a way of protecting values, even though you're not in the market to make a lot of profits. It is also a way to protect whatever you have earned so far. But I'm not saying that you should go all into the stock market, but you might want to have some bonds, some some stocks in there, and have a modest risk taking. And I think that's the best thing in the long run, because stocks and bonds are usually a much better protection against a lot of these extraordinary events that we can see happening sometimes.
Yeah, absolutely. I know that some investors or some people are afraid of investing because they are afraid of the companies going bankrupt. But I couldn't imagine a situation when all companies all over the world went bankrupt simultaneously. No, that's not possible.
But it can happen to your bank or your government.
Yep, yeah. So if you have ETFs with allocation into blue chips in the US, in Europe, in Asia, in Russia, etc., then you won't be allocated into one or two or three industries, into 1, 2, or 3 companies. So that's the way you can manage your attitude towards risk, to just to get hold of your money and to manage your risk to lose everything. It is not possible. It is not physically possible to lose your money because, well, as you can see, it is not possible that all companies all over the world went bankrupt simultaneously. Not possible. Even during the Great Depression, as you can see. Another question is about emotions. The question is, I think, a bit too general, but still. How emotions are influencing our investments?
Well, that's also a great question and a big topic. I have when I talk to these things with my students, I usually spend 2 hours. But in essence, I think it's not different from any other decisions that would affect emotions. So we know, for instance, that if you get a stupid email or text message on your phone, the best advice I can give you is maybe not to respond immediately, especially if it's a senior colleague or something, your boss at work. you should wait a while, because you shouldn't act when in an emotional state. And there's actually plenty of research that shows that the best decision maker you could be is when you're comfortable and you're happy, and the bad decisions that you make are when you're very emotional, and typically when you're angry or sad. So try to stay away from making any decisions also outside of finance when you're in an emotional state.
Yeah, so keep calm and stick to your strategy. That's it. Yeah. Another question is, that's in English, so I'll just read it loudly. Lately, some products in my portfolio have been continuously demonstrating tendencies to fall. I'm getting worried and checking with my personal bank manager if it's time to probably sell them. The answer has been to wait, assuming that the situation will improve. What to do? How long this waiting period can last before I can start to lose critically? Also, the language of my bank managers when we see decrease of products is, it is not fall, it is correction. Frankly, this formulation makes me worry and sometimes doubt transparency, at which point correction develops in fall. Thank you. Well, I think it's
that's a tough question, but what I would do is to ask my advisor to give me some kind of evaluation of the portfolio. So here again, benchmarking is useful to say that you have Russian stocks, then it would be interesting to see what the performance of your portfolio has been in comparison with a index strategy, just investing in the Russian index, or if it's the world index, or whatever benchmark that you have. So benchmarking your portfolio is really important, and that is something that one should talk about with an advisor before investing. It is never too late. And then I think one should do these evaluations of portfolios, reoccurring evaluations. Now it's very difficult to say at what time period. So it depends a little bit on the strategy. So there are a lot of, I forgot to mention that, but if you still don't want to be all passive, there are also other instruments that actually have strategies in them. For instance, they buy low risk stocks, and they could be low beta strategies. You name them. There are a lot of different investment strategies that could be replicated in mutual funds or in ETFs. And these are all sort of valid benchmarks to have once you start investing. What kind of portfolio do you want to have? But in the end, it's all about diversification. So if it's only a portfolio with a couple of stocks, I mean, I wouldn't be surprised if the portfolio is underperforming. That's what we see in all these graphs.
Yeah, I totally agree. It's better just to look at the benchmark and to ask your bank manager about the reasons why your portfolio shows this kind of drop. For example, if you're having some kind of your capital allocated into Chinese stocks, then it is obvious that this part of your portfolio would be decreasing nowadays because of the obvious things connected with the overregulation by the Chinese government. So it has nothing to do with the instrument. That's just life. That's the way Chinese market performs nowadays. If you are having some stocks in oil and gas companies, nowadays you might see how the price drops because the oil price drops, and that's obvious that we will have some resemblance between these two. But if the markets are up and your portfolio is down, that's not life. That's not correct. So you should go in depth into the reasons why this is happening. And on top of that, you should always think about the time frame for your strategy. For example, if you see a drop after a day after you buy this or that instrument, it's okay. So you shouldn't be too much worried about this kind of drop, because if you are investing for, say, 10 years, 20 years, this kind of drop is negligible. Okay. Another question is about the first slide of our webinar, not yours, Anders, but the slide by the Citibank. The slide states that personal finance is more personal than it is finance. Shall we minimize personal? Does it good or bad?
Yeah, I mean, financial markets are what they are. They're very competitive, right? It's always like the question you should be really asking yourself is the same as you would go into a poker table. If you don't know who the sucker is around the table, it's probably you yourself, right? and the answer to that question is usually that you are, right? Because you're not a specialist, you're an individual investor, and there are a lot of institutions out there. There's so much money out there, and the only thing that they want to do is to beat the market, and that means beating people like you. So if you take a more modest perspective, I think you are much more to gain from detaching yourself from emotions and all of these behavioral biases, and just accepting that investments is a vehicle for you to accumulate wealth over time, and it's not mainly entertainment or something that you need to put aside a lot of time for every day in order to pursue.
Yeah, I agree. Well, we cannot omit personal when we are investing, because we are human beings and we are investing to reach our personal goals. So we just have to manage our personal biases to make our investments more profitable and rational. That's it.
I usually have one advice actually when I talk at events like this, is that so you should probably not change your portfolio when something happens in the market. The time you should change your portfolio is if something happens to you or something in your life. So if you have something changing, you're buying a house, you're getting married, or whatever, that's a good time to think about how to change your investments. It's not typically when the Chinese market is down or the oil price goes up or whatever. That's not the time to make these decisions.
Oh yeah, I totally agree. And we've got the last but not least question that I think we should address, because we've got, I think we will have a lot of questions, but that's not the last webinar by Citibank devoted to behavioral finance. So we would cover all the other topics in the next webinars. Okay, the question is, contrary to overconfidence bias as typical for ex-Soviets 50 plus, I'm continuously struggling with my overconservative behavior. I perceive stocks is almost like wasting of money. I believe I don't have a moral right to invest unless I know all nuts and bolts of the company I consider to invest into, but I simply do not have time to go through a profound study. Sure, I'm one of witnesses of perestroika heat, but how to overcome such bias? Interestingly, I say my level of confidence of foreign investments is much higher, despite it is much riskier than stocks and forex and investments as well. Maybe this is also a kind of a trap. That's a complicated question, because frankly, it would be better if we could see the current portfolio of the participants and ask some questions about the forex experience, whether that was good or bad. But nevertheless, again, what do you think of this attitude towards?
Yeah, but I mean, it's exactly what we talked about before, right? I'm not surprised that people have these, doubts about the market if you've had bad experiences in the past. But the way to think about it is again that then try a passive investment strategy. And if you're uncomfortable with risk, maybe what you should do is do it sequentially. You can start off by a small amount, put that aside and see how things go along. And if you feel comfortable with it, you might want to increase your savings and your risks. So I think it's never too late to start investing. The only crime that you really can commit to is that you never get started, because there's such a high power of compounding. So essentially you can double your savings in every, say, 10 years by diversifying properly into stocks. And that's quite an achievement, I think. So, but time is your friend here. So I would say, don't be too scared. It's better to start with something than to stay out.
Okay, we've got one more question.
All right, shoot.
So could you please recommend maybe some courses, webinars, books for the beginners, investors, just to avoid most common mistakes, but we cannot promote any kind of specific online education courses?
No, but I think, so myself, I started out by reviewing some books by Richard Thaler, who won the Nobel Prize a couple of years ago. He has a few books. You might want to look into those. Also a great book is that with Daniel Kahneman. It's also a Nobel Prize laureate from 2002, I believe. He's a psychologist, but he talks about many of these traps in a more general way. It's very entertaining and interesting, I think. So these are all like bedtime reading books that anyone can digest, I think. So these two people, look them up and have fun.
Yeah, I would just add that many top brokers also organize a lot of free webinars devoted to financial literacy, some basics of investments, etc., etc. So you can attend those webinars as well, and just feel free to surf via internet and find what's more applicable and relevant to you. Okay, so of course we've got a lot of minor questions like what is trading, how many stocks is enough for a portfolio, and what benchmark should we use to assess our portfolio profitability, etc., etc. So I think, well, we have covered most topics we intended at first. And it is not possible to cover everything in one webinar. So I'm more than sure that this Citibank would organize more and more webinars devoted to investments, investors' biases, mistakes, and all that stuff. So just follow Citibank and attend new webinars by them. Many thanks to you, Anders. That was incredible. That was really in-depth. That was perfect. Thank you very much for sharing your expertise and for the way you just conducted this webinar. That was so great, frankly.
Thank you very much. Thanks for having me.
Okay, thank you all. Thanks to all of our participants today. Thank you for your questions and thanks for your thoughts. And we hope to see you on the next webinars. And again, this webinar has been recorded and I will place this on my YouTube soon. Many thanks to all and have a nice day, have a nice week, and let your investments be profitable with no mistakes. Bye.